Well, there was no new news. Basically what happened was the RBA cut rates. That's essentially because the economy is still growing but it's slowing and unemployment's going up, inflation's low, so they've been sending signals that they think they need to cut it again, and so that's what we saw. I think it will basically help at the margin, because what it will do is it will help house prices go up and increase, therefore, people's wealth. Will it have a large impact? The answer is no, because one of the problems you've got is the consumers are still scared, and in that sort of environment, they're not really interested in increasing their borrowing, and cutting the price of the borrowing really isn't that relevant. For the rest of the year, we're expecting another rate cut around about November. The reason for that is you get another low CPI at the end of October, and we expect unemployment to be around about 6% for then. So basically what it's saying is you'll need to do more to support the economy. Who benefits most? Obviously the people that have debt, and particularly mortgages. That's the most likely benefit. Those who have more difficulty will be retirees, where you basically got interest rates that they're trying to live on going lower. What they're saying about the US is the economy is growing, but it's very patchy. Hopefully it's starting to show a little bit of acceleration, but really they've revised down a history a fair bit, and so growth this year is unlikely to be much higher than 1.5%, and that's pretty low. The positive sign is the unemployment rate continues to track down a touch. Overall, I'd sort of summarise the US as okay, bouncy, but not great. China's slowed to about 7.5%, which is really, to some extent, what people expected. The problem really is whether it will slow even further. Now, the reason China's slowing is basically the government is trying to damp down the housing sector and also shadow banking. So they're trying to get lower growth that's better quality. As we go forward, I expect that China will still continue to grow a little bit, somewhere between, let's say, 7 and 7.5%. Australian dollar's basically fallen because people are getting more optimistic about the US, and the US is signalling that they're going to stop printing money or slow down in the rate of which they've been printing money. And there's also been a combination that China is not quite as strong, it's slowing, and the domestic economy is also slowing. So you put all those things together and people basically think that the Australian dollar is probably going to go down a bit. And there's also a lot of hedge funds who've basically taken a short position on the Australian dollar. What do we expect to go forward? We expect commodity prices to continue to weaken. We think the Australian economy's got to sort of go sideways. So we have 88 cents by the end of the year and about 83 by the end of next year. The unemployment rate is currently at 5.7%, and youth unemployment significantly higher. What's really happening is the economy is growing at around about 2%, and that's pushing the unemployment rate up. And we expect it will continue to go up to about 6.25%. In terms of, is it a fair statement in terms of general levels of unemployment? Australia uses the same definition that everybody around the world does. So yes, there are people who basically would like to work more or would basically like to work longer hours, but our rate for what we are is basically the same as everywhere else. If you want a measure of the degree of underemployment, in other words, people working longer hours, etc., it's more around about 12%. The government does have a $30 billion reduction in its receipts relative to what it was expecting at budget time. We heard that in their update of their economic statement last Friday. What they've tried to do is offset some of that by essentially changing the fringe benefit tax on car leases and also the financial stability levy. And at the end of the day, the reason that this is happening is essentially the economy's softer, particularly nominal demand, but essentially the terms of trade are slower, so inflation's a bit lower, and the economy's not growing as much as they thought. So their idea is to let the deficit become larger in the short term, of a deficit of around 30 bill. and hopefully they'll get back to a surplus by 2016-17. Even there, I think they've basically got a few heroic assumptions, and our view would be that it's unlikely, given the current framework that they're talking about, that they'll get a surplus even by 16-17. Housing affordability is an issue basically because of the higher level of Australian house prices. You can cut interest rates, which makes things a lot more affordable, but it's still difficult essentially to get your toe into the market. And so in that sense, people are worried about their affordability. Also, generally, people are worried about the cost of living in the Australian economy. And so that's a general issue. But the housing affordability one really reflects 20 years worth of strong growth in house prices. Well, the Victorian numbers basically bounced up from a very soft period for about 6 to 12 months. So over the last 6 to 12 months, Victorian property prices were probably the weakest of any of the states. As you continue to cut rates and the Victorian economy sort of struggles along but doesn't get any worse, then essentially house prices go up, and they've come from a lower base, so they've gone a bit faster. Generally, overall, we would expect house prices, however, to be up around 5 to 7% over the next 12 months. The main reason that house prices are going up is basically interest rates have come down. The Sydney market has been pretty flat for a while, and it's got a undersupply issue, so therefore prices go up a bit stronger. Perth, I think, is essentially a remnant of the housing boom, and I think probably as you look forward, house prices will probably start to flatten off there. Overall, as I said, it's interest rates that have sort of been helping, but as unemployment rises, that will neutralise some of that increases, and we would expect overall house prices to increase by around 5%.